Uh-oh, so you made a mistake. What do? Panic and run out of the room and say the room's on fire? I probably would, right? Make an error on the financial statements. Just head for the hills, run away. Now, so what are we going to do when we have an accounting change or an error corrections? I don't like change. Why can't we just stay the same? But we're going to have a couple items here, really four. We have three accounting changes and, well, an error. That's just one item. You can make a bunch of errors, but that's just its own category. In those four categories of possible actions we need to take, what do? Let's go through the objectives so we find out. Well, for our learning objectives, first we want to calculate a required adjustment to the financial statements due to that accounting change or error correction, and determine whether it requires a prospective or retrospective application. We'll get into what that means, but basically, do you account for it in the future, like going forward, or do you have to go restate the financial statements because of those errors or those accounting changes? I'm not going to spoil it for you. We're going to see that. Lastly, derive the impact to the financial statements and related note disclosures of an accounting change or error correction. For some items, you might just disclose. For other items, you might record and change something. Just like in subsequent events, there's a lot of different notes in the financial statements sections where we've seen this, right? Do we actually make a change in the numbers? Do we record or recognize? Or do we simply just disclose? We'll see that and more. Let's dive in.